AI.
On AI.
AI.
AI safety resigned this Monday.
So, in 1988, a company called Zapata Corporation, a fish oil and protein business, announced that it was pivoting to the internet, rebranding around Zap.com. While they just kept making fish meal the whole time, in 2017, Long Island Iced Tea Corp, a beverage company, renamed itself Long Island Blockchain Corp. No product change, but the stock spiked as much as 380% intraday, closing up 183%. Sounds familiar? Today, if you're a public company and you're not an AI company, you're leaving money on the table. Watch what happens to a stock price when the CEO says the letters A and I back to back on an earnings call, and they aren't even being subtle about it anymore. And nowhere is this pattern more visible than in a company most people don't even think of as an AI company at all. This is a video about how we got here and why the most honest mirror for this entire moment might be a rocket company. Surprisingly, not in 2022, not ChatGPT. That's actually the marketing origin story, not the real one. In 1956, Dartmouth, a summer workshop where a handful of researchers coined the term artificial intelligence and predicted that machines would match human intelligence within a generation. They were off and are off by roughly 70 years and counting. What followed were decades of boom and bust cycles. AI summers and AI winters, funding surges followed by disillusionment when the technology couldn't deliver on the promises made to secure the funding. The actual technical thread that leads to today started in the 1980s and 1990s with neural networks, which were mostly dismissed as a dead end. In 2012, AlexNet, a neural network, wins an image recognition competition by a stunning margin, proving deep learning might actually work at scale. And in 2017, a Google paper called Attention is All You Need introduces the transformer architecture, the T in GPT. In 2022, ChatGPT, which is not a technical breakthrough so much as a packaging breakthrough. The tech had existed for a while, but what changed was that now Iran could use it. That last point is the one people miss. The 2022 moment wasn't AI getting smart, it was AI getting a user interface which made it easier to use, and user interfaces are what turns technology into capital events. After you strip away the demos, here's the current state. Large language models are great at pattern completion across text, code, and increasingly images, audio, and video. But an important distinction is that they are not reasoning a way a human does. They're doing something for which I would argue that we do not have a great language for yet. Something that resembles reasoning, often enough to be economically transformative and philosophically very confusing simultaneously. Meanwhile, the money side of this looks like nothing in tech history. We have parallels in certain small aspects, but the current AI scene is on a scale we cannot fathom. We're talking about hundreds of billions of dollars, now almost trillions, in committed capital expenditure, data centers, chips, power infrastructure, from a mere handful of companies, justified by revenue that in several well-documented cases doesn't exist at the scale required to make the math work. And this is claimed openly in earnings call by the executives spending the money. They're betting on the infrastructure now on the assumption that the returns arrive later. We've seen this movie before. That's the railroad boom of the 1840s. That's a fiber optic cable in 1999. Companies laid so much fiber, so far ahead of demand, that dark fiber, installed but unused cable, became a term of art. And it took over a decade for usage to catch up to capacity. The infrastructure outlives the hype cycle. The investors who funded the hype cycle often do not. In June 2026, SpaceX goes public. Largest IPO in history. $75 billion raised. Debut valuation around $1.75 trillion. Weeks earlier, it had quietly closed something else, buying xAI, Musk's AI company, Grok, the Colossus data center, X, all folded straight into SpaceX's books as a reported segment. So the rocket company is now, at least on paper, some kind of an AI data center company too, I guess. Here's what the actual business looks like. Starlink works, subscribers doubled past 10 million in a year. but revenue per subscriber actually fell from $99 a month to $66. More users, less money each. Total trailing revenue, about $19 billion. Pretty good, but not incredible. And here's what the market paid for that: $2.1 trillion. A price to sales ratio of 141, triple Nvidia's, on a company that lost $5 billion last year. Even Morningstar, not exactly a hype outlet, called it the most overvalued stock they cover and pegged fair value at about $780 billion, less than half the IPO price, but still comically high. 2.1 trillion priced in, 780 billion of actual math underneath it, $19 billion of revenue underneath that. That gap is the whole video, condensed into one company. And here's the scary part. None of this is hidden. It's not a scam, it's a whole strategy. Buy the AI company, staple it onto the rocket company, watch the multiple re-rate. Starlink took 20 years to become a real business. Buying XAI took a few months to change how the market prices the whole thing. That's not a knock on Starlink, it's a knock on what the market is actually pricing now, which more and more is in the business. The earnings call, the balance sheet, the thing the company actually does is increasingly besides the point. What moves the number is the story about what the business might become, stapled to a buzzword the market has already decided to trust. Not the robots, but the incentive structure. When add AI to your pitch deck is a reliable way to move a stock price, the rational move for a public company isn't to build something good anymore. It's to just say the word.
Say the line, Bart!
Artificial intelligence.
Yay!
This is flat out measurable in stock reactions to earnings call language over the last few years. Layer onto that, companies conducting layoffs while simultaneously citing AI efficiency gains in the same quarter. In some cases, before the AI tooling in question is even fully developed. Whether AI is actually the cause of the layoff or the justification for a layoff that was coming anyway, that is not up for debate. Anyone with half a brain cell can see through the BS, and that blatant deception is itself the point. AI has become a boardroom-approved euphemism that requires no further explanation. This is the dot-com playbook, the railroad playbook, the telecom playbook run again, faster, with more capital, and with a technology that, unlike a mile of unused fiber optic cable, can plausibly touch cognitive labor instead of just physical infrastructure. That's the actual novel risk here. Previous bubbles overbuilt pipes. This one is overbuilding a story about what human judgment is actually even for. Unfortunately, not the Terminator, but something slower and more boring, and that's the part which sucks. We were promised neon lights, cyberware, and megacorpos with the fashion sense of Prada. But what we're getting is a clown show with a distinct smell which makes you look around to figure out who it was that actually soiled the pants. There are two ways this could go, and history says one is comically more likely than the other. The optimistic case. Artificial intelligence absorbs the tedious 60% of most jobs. Human work shifts towards judgment, taste, and interpersonal work machines remain bad at. Productivity gains eventually get shared broadly enough to matter. The bleak case gains concentration in the handful of companies and founders who own the infrastructure, and the narrative labor displacement outpaces the emergence of new categories of work, and the wealth generated doesn't trickle anywhere, but instead it pools the way capital pooled after the railroad consolidation in the 1870s, in the hands of people who own the track, not the people who actually laid it out. History doesn't repeat, but the ownership structure of new infrastructure tends to. So the question here is, who owns the infra it runs on, and whether this cycle ends differently than the fiber optic cable did, where the capacity got built, the first wave of investors got wiped out clean, and it was the next generation of companies who quietly bought the leftover pieces for cents on the dollar and built the actual internet economy on top of it. Someone is going to be that next generation this time too. It probably isn't going to be the one who the current hype cycle expects. Zapata Corporation, the fish oil company that pivoted to the internet in 1999, well, they didn't become an internet company. The stock crashed back down within a few months. The fish oil business is in fact still, unfortunately, just a fish oil business. The technology behind this current moment is real in a way a lot of the 1999 internet pivots weren't. That's what makes this a bit more dangerous, not less. A bubble built on nothing pops and leaves nothing behind. We can start anew, fresh. A bubble built on something real just leaves behind an economy reshaped around whoever survived the popping. And to close off, if this kind of thing is interesting to you, then that's basically what this whole channel is about. So don't forget to hit the subscribe button. And I'd genuinely like to know, what's the next AI company you think which doesn't really hold up? Drop it in the comments since I read all of them.